At MSCI, one of the things that we actually are well known for, as you know, is our indexes. And part of the reason why global and institutional investors around the world use us and follow us is due to our methodology. We would like to be able to provide something that is an accurate measure of markets. And what I mean by accurate is we want to be able to give access to our investors to the full opportunity set within each and every market that we work in. It is fair, transparent, and cost effective. And I'll go through all three of these. Just briefly, when I spoke about giving access to the full opportunity set, in each market we endeavour to try and cover 85% of each market from a standard perspective. And when I say standard, I'm talking about the large cap and the mid cap, which makes up 85. And when you add the small caps, we'll have a 99% coverage. This is a fluid number where we actually do reviews on a quarterly basis. As mentioned earlier, the full opportunity set is called the Investable Market Index. This little box is actually quite interesting. This is where, from an MSCI perspective, we would ideally like to see all emerging markets. So as you can see, we've highlighted Thailand here. Thailand fits in the box. What this actually just means is that from our perspective, any countries within this box fit squarely in the emerging market space. It also means that we are working from a size and a market coverage point of view that is non-volatile. What do I mean by that? I.e., during each of our reviews, there are a minimum number of additions or deletions that will actually disrupt the market. As you can see, outside of this, we have Mexico, Brazil, Colombia, India, and Taiwan is just outside. But from a Thai perspective, it seems like a lot of the information has already been absorbed into the market, and you're still sitting squarely within this box, which is actually good news. This is the interesting part. How do stocks get in or out? From a large cap perspective, we look at full market cap, and it's currently sitting at 6.4 billion. For a mid cap, it's 2.1. Small cap is 162. But the important figure that we should look at here is the free float market cap. The free float market cap is one of the interesting parts from a Thai perspective, because this is one of the reasons why we currently only have 28 stocks in the MSCI Thailand Index. We also look at liquidity, and for emerging markets, the ATVR, or the annual traded value ratio, it's 15. We also look at the 3 months, and also the 3-month trading frequency has to be a minimum of 80%. And the foreign free float is 15% currently. And just to give you an example of each of the stocks that are currently in our index, PTT is in as a large cap, and Thai Airways. We only just recently had our May review, and from that review, we are actually going to be adding Bumrungrad Hospital as a mid-cap. It will be added in at 2.25 billion. So essentially, it will be sitting in this range here. Now, when I mentioned earlier about the cost-effective part, this is essentially what I meant. Whilst we do have a structured methodology from an inclusion and exclusion perspective, we don't want to disrupt markets. So in essence, what we do is we actually put in buffers for each of the grades, small, mid, and large cap. So if you have a look at the graph, the buffer here, a stock has to move by 50% or drop by 50% before we will actually move it outside of its current classification. This way, it actually helps minimize the volatility and a cost from a trading perspective of anyone who actually tracks our indexes and has to make those changes. The only thing to note here is I mentioned earlier our quarterly reviews and our semi-annual reviews. The quarterly reviews are even more extreme, and what I mean by that is that the buffers are even higher to ensure that there is minimal volatility as opposed to the semi-annual, which is the 50 and the 33. Just a quick look at the MSCI Thailand Index. From a historical point of view, MSCI Thailand was added into the emerging markets back in 1988. But in 1996, 97, as you can see, it dropped. And this was basically due to the Asian financial crisis. One could say that one of the reasons why Thailand hasn't recovered from a weight perspective within the emerging markets or even the ACWI is due to a few reasons. One of which is these three: China, Korea, and Taiwan being added. So unless Korea and Taiwan are removed from the emerging into developed, there is not a lot that's, from our perspective, that can be done with regards to the weight of Thailand, other than the foreign ownership levels are looked at, or we see more IPOs, large IPOs, within the Thai market. This is just a quick high-level comparison between MSCI Thai and the SET 50. As you can see, we have the current number of stocks that we have in our index is 28, or 121 when you include the small caps, as opposed to a fixed 50. One thing to note here is that how it works, or my understanding of how it works, is that with the SET 50, it's one stock in, one stock out. Whereas with the MSCI Thai Index, it's fluid. Basically, that 28, that number, that 28 and 121, is always changing. So long as a stock meets our criteria, it will be included. So in essence, this 28 could be 50, could be 60, or could be 10. Again, just a quick look at how this looks from a drill down perspective, from a weightage. Because stocks are similar, the weights can be similar as well, as you can see from Siam Commercial and Siam Cement. If you'd like, I can just give you a brief rundown of how we look at foreign ownership and foreign inclusion. If you were to, say for instance, have a stock that had 100 shares, how MSCI looks at it and how SET looks at it, it's a bit different. So for instance, stock A has 100 shares and has an FOL, or foreign limit, ownership limit of 50. Plus also the senior officers in this firm hold another 40%. How MSCI views that is that the 50 plus the 40 minus the 100 is just 10. So that for us would be the actual amount that we would look at. From SET's perspective, they would look at it as 100 minus the 40, minus the 50, and then you have, minus the 40 from the officer, and then you'll have 60. So that is the actual difference. Again, just a quick sector profile of where we sit with regards to SET 50. We are overweight in financials and underweight in telecommunications. From a historical performance perspective, even though there are only 20-odd stocks in MSCI Thailand, we do compare fairly well, and there's only marginal underperformance. Risk is the same. The maximum drawdown, though, is actually quite interesting, where we seem to perform a little bit better. So unless anyone has any other questions, I'll actually move straight into our economic exposure. Now, one of the things that has come to light in recent times is one of our clients came to us and said, we have a very, very large portfolio, except we would really like to know where we're actually invested in, i.e., are we actually in developed markets? Are we actually in emerging markets? Are we actually in Thailand? Are we actually in Hong Kong? So one of the ways that we actually looked at this was, okay, the standard view is to go by market cap. You would invest via market cap. We found something that was actually quite interesting when we actually looked at it from a different point of view, from a revenue perspective. So for instance, if you were to look at Apple, if you were to buy an Apple share, you would think quite correctly that you were buying a US stock. But from a revenue perspective, only 41% of the revenue comes from the Americas, and of that, only a portion is actually from the United States. The rest is from Asia, Europe, and other countries. So what this actually says is indirectly or even directly, your portfolio is actually exposed to the risk and also the possible returns of all of these other countries as well. Now, the question is that deliberate or not? So what we came up with was a new way to look at your portfolio, what we call the MSCI Economic Exposure framework. What we did was within our whole universe of 8,500 stocks, we looked at the raw data, the actual annual reports, the revenue numbers, and we came up with some exposure files so that basically what we did was we looked at the stock, where the revenue was generated from a country perspective, and we allocated that a percentage. If there was no, so if I go back, if there was no number, so say for instance, if other or even Europe, there was nothing there for Europe, we would actually just put it as according to the actual country's GDP. This tells a very interesting story. So what does Thailand look like from an economic exposure point of view? As you can see, if you're investing in Thailand, you're pretty much investing in Thailand. This is the Asia portion, and this is the rest of the world. So the question you would ask yourself if you're an investor or even a portfolio manager, if I wanted to invest outside of Thai, but I didn't want to go full global, where could I go? Possibly Singapore. So if you were to buy a Singaporean stock, you'd be exposed to Asia, the Americas, and also Europe. That is one possibility, and this is one way that a lot of our clients are looking at now when they're looking at their portfolios, not only from a market cap perspective, but effectively from where these companies are generating their revenues. Just a split down of the whole world. As you can see, if you're looking at it from a market cap perspective, the emerging and frontier markets, of which Thailand is a part of, if we were to split from an asset allocation point of view, this is what it could potentially look like. 10.6% would be the allocation. But from a revenue exposure perspective, that number just almost triples. This is the interesting part. Again, just a look at it from a risk management point of view. If you were to look at MSCI Europe with a pure domestic exposure, Europe, investing in Europe was down 7%. But if you looked at Europe with an international exposure, so those stocks that had exposure outside of Europe actually did quite well. And the same can be true for the UK. So one last slide before I finish. I didn't choose Carlsberg. I personally preferred Chang or Singha, but it didn't quite work out. Just so that to put a point into a picture perspective, Carlsberg has a fairly significant weight in MSCI Denmark. Now, if you have a look from an economic exposure perspective, they have the largest market share in Russia at just under 40%. That is huge. So if you have a look at what's happened here, MSCI Denmark has performed quite well. Russia, on the other hand, has actually not performed too well. And how that has affected Carlsberg, it's actually gone down. This is where the proof in the pudding is from an economic exposure point of view. So as you can see, there are very, very different ways to look at your portfolio. One of the new emerging ways to look at it is from an economic exposure. So, in conclusion, what I'd hope to achieve today is to give you a bit of an insight into who MSCI is, how we actually look at the world, how we view the world, from a global, country and domestic point of view. We do adopt a fairly consistent approach across the board, which is why from our investors' perspective, in any country, in any region, in any part of the world that they invest in, they know that they can compare apples with apples. And last but not least, the economic exposure of any company that you look at can serve as a complementary view on top of what we actually currently offer as well. I hope I haven't confused you all too much, but if you do have any questions, I'd be happy to take them.
Thank you very much. I had a question on the Apple. I didn't quite follow when you said that if Apple didn't have sales in Europe, you would then put the GDP weight of Europe in that.
Yes.
Europe is already a quarter of the world anyway.
So I do apologize. When I say Europe, what we would have done, instead of Europe, we would have actually broken it up into the various countries in Europe and gone according to their GDP and then just calculated it up. Any other questions? No? Well then I thank you for your time and hopefully you'll enjoy the rest of the seminar.
Thank you very much. So after this, we will be having a 15-minute coffee break right here in the front of the auditorium before coming back for another highlight of the seminar, the section of portfolio construction at about 10:30. See you after that. เป็นภาษาอังกฤษนะครับพูดภาษาอังกฤษ